Hello, ladies and gentlemen. This is the group Ladies and Gentlemen. Today, we would like to present to you our study on the inflation difference between the GFC, short for global financial crisis, and COVID-19 in the United States. Since the GFC in 2008, low global inflation has become a norm. However, after the COVID-19 attack in 2020, this pattern changed. The level of inflation in the United States continued to rise higher than expected. Since April 2021, the PCE, CPI, and PPI in the United States have all risen to a new high ever after 2008, and there's no downward trend at present. Why is that the case? Why did inflation react differently during these two crises? Our group is interested in the reasons behind. This is our agenda. Let's start our navigation from an overview of these two crises. The global financial crisis refers to the period of extreme stress in global financial markets and banking system between mid-2007 and early 2009. The root cause of the GFC is an endogenous shock. Before the GFC, economic growth was strong and stable, and house prices soared. The expectation that house prices would continue to rise led to lots of borrowing to buy and build houses imprudently. However, people found it difficult to keep up with the extraordinarily high mortgage payments and defaulted at last. With a large supply of houses and the declining demand, the house price started to drop strictly and the entire market collapsed. In contrast, the COVID-19 recession in early 2020 is due to exogenous factors. Caused by the coronavirus, it's considered to be the shortest economic recession on record. The US economy was doing well before the pandemic. Both unemployment and inflation were stable at relatively low levels. After the pandemic outbreak, people were afraid to go out while the government also imposed serious restriction on social freedom and movement. Therefore, production activities are largely forced to halt. As a result, many people lost their jobs and corporations went bankrupt. The US GDP shrank in 2020 at an annual rate of 3.5%, becoming the biggest decline since 1946. The US government and central bank took a series of actions in response to this crisis. There are three categories of monetary policy enacted to cope with the GFC. First, the Federal Reserve provided short-term liquidity to banks and other institutions. Also, it offered liquidity directly to borrowers and investors in key credit markets. Besides, it employed open market operation mainly by purchasing bonds to facilitate economic recovery. Meanwhile, the US government enacted various fiscal policies. Tax incentives were given to business as well as individuals. Higher limits were put on certain mortgages. In addition, in 2009, government spending was raised to cancel off the decline in individual consumption. When responding to the COVID crisis, the Fed mainly made three monetary policies. First, the benchmark rate was cut twice in March 2020. Second, quantitative easing was launched. Third, credit barriers were lowered while incentives increased. As for the fiscal policy, the US government released a large amount of funds to help recovery. In March and April 2020, three major aid programs were passed. We can also have a more direct view of this in dollar terms. Trump issued $3.1 trillion in stimulus, while Biden unveiled a bill requiring $4.15 trillion, which is about 20% of the US GDP.
Now, let's have a look at how the crisis and responses affected the US economy. Interestingly, we have found that CPI diminished substantially in the GFC, which eventually led to a period of deflation. However, during the pandemic economy, CPI initially dropped and then surged from May 2020. To further investigate the different patterns of inflation responses to the two economic shocks, we looked into various economic indicators. First, we observed that the retailer's inventory to sales ratio has hit the lowest record during COVID, which reacted differently from GFC. The reason behind this may be the difference between supply side and demand side impacts. We also noticed that the household debt to income ratio has declined to the lowest level in COVID, while it didn't drop a lot during GFC. Accordingly, the personal saving rate has broken the record. The highest point occurred in 2020, being almost 7 times higher than normal. This may be caused by the unfulfilled demand in the COVID-19 recession. Moreover, since the economy needs time to reflect bankruptcy and employee dismissal, we can see the unemployment rate gradually going up in the GFC, whereas it soared rapidly in 2020 due to sudden pandemic and enforced lockdowns. Lastly, we'll look at manufacturing PMI, which was lower than 50 during both GFC and COVID-19 recession. PMI recovered gradually in the GFC when household demand recovered, but during the pandemic economy, it increased back to the original level quickly as the production resumed. So from the data above, our hypothesis is that the GFC was a demand-driven event and the COVID-19 recession was a supply-driven shock. So we suspect that demand-related macroeconomic indicators should play a bigger role in affecting inflation during GFC compared to the COVID, while COVID was more influenced by supply-side dynamics, and the supply-side indicators should have more prediction power during COVID.
In order to test our hypothesis, we plan to construct a regression model that estimates the prediction power of supply-side and demand-side variables to inflation. This would involve gathering 2 sets of data, one spanning across the GFC and another across COVID-19 crisis. We did the time framing, and our data ranging for GFCs from the beginning of 2007 to the end of 2009. During the GFC, troubling signals first emerged in the second half of 2007, while it was until late 2009 that the US economy went back to growth. For COVID-19 data, although the precise timeframe for a recession is rather short-lived, the US economy is still coping with the impacts brought by the pandemic. Therefore, we collected data that ranged from the beginning of 2020 to date. Considering that it has only been less than 2 years since COVID-19 crisis hit the US, we opted for monthly data over quarterly ones in order to compensate. As shown in the slide, we have chosen CPI inflation as dependent variable, ISM Purchasing Managers Index, so-called PMI, and the saving rate as independent variables. We chose to look at the year-over-year change of the CPI for all urban consumers in the US from Fed as a measure of US inflation. Compared to GDP deflator, this metric should be closer to the core inflation, which the Fed closely monitors. PMI is selected as a proxy for the supply-side dynamics. It is based on a survey of purchasing managers at more than 300 manufacturing firms. PMI takes into account production, supplier deliveries, and inventories. A PMI above 50 indicates an expansion compared to the previous month, and below 50 reflects contraction. For our regression, we have subtracted each month's PMI figure by 50, so that a positive or a negative reading shows expansion or contraction. This transformation prevents misunderstandings since the original unit change above and under 50 carried different meanings. Personal saving rate from Fed as a proxy for demand-side dynamics should be inversely related to spending and demand. We have also considered using GDP growth, but it is a quarterly indicator, and so it is not suitable for our need for sufficient data points. Going to the regression model part, our group opted for the vector autoregressive model, which takes into account the interactions between multiple time series. We will use it to study how inflation rate is affected by its own lags and the lags of manufacturing PMI and saving rate. Based on a holistic assessment of the AIC, BIC, and HQC, we will be using two lags in our research. There are a few assumptions we have to be made for the estimations to stay consistent and can be evaluated by statistics and p-value. The error term has a conditional mean of 0. The variables in the model are stationary. Large outliers are unlikely, and there are no perfect multicollinearity. And therefore, we will have several checks on the assumptions to make sure our model is effective and capable in explaining our target variable. First, multicollinearity check. In order to prevent having perfect multicollinearity among variables, which could undermine the statistical significance of variables if we ignored it, we use heat map to check if there's any highly linearly correlated independent variables with values very close to 0 or 1. From the graph, we don't observe any outstanding correlations, and so we assume all variables can be preserved. Second, stationarity check. Augmentative T-Fuller test is used to check for stationarity in time series. The ADF test tells the presence of a unit root. If the null hypothesis of having a unit root is not rejected, the time series is said to be non-stationary. Results show that transformation is needed. And so we did first differencing to make data stationary. Third, serial correlation check for residuals. To make sure there aren't any leftover patterns in the residuals that the model hasn't explained, we use the Durbin-Watson statistics to test whether the model is sufficient in explaining the time series. All the values are close to 2, which shows no significant serial correlation in the errors. This model is able to explain the variances and patterns in the time series. In addition, we did a point of sudden change in CPI detection to study when exactly does the CPI rate substantially change, and further understand the reasons behind. Asian online change point detection is used to detect sudden changes in the time series. For GFC, it shows that September 2008 is the month where inflation starts to have a significant change. It is the month when subprime mortgage crisis reached its critical stage and when the bankruptcy of Lehman Brothers started. For COVID-19, the US suffers a sudden inflation shock in January 2020, which is also the month when the first case in North America was reported.
Now, moving on to result analysis. This table you see shows the VAR model obtained from the GFC data. Significant coefficients are circled in yellow. Then we have the VAR model obtained from the COVID-19 period. Now, there are three main observations from our regression results. The first observation is that the coefficient of saving rate in both models are positive. This could seem counterintuitive because high saving rate is usually seen as an indicator of low inflation expectation and thus low interest rate and low opportunity cost of saving money. But our result seems to say that the higher it is, the higher inflation is likely to be. And on this matter, we come up with two potential explanations. First is that saving rate only captures the household component in demand, while corporate and government demand are left out. During GFC, the US government introduced fiscal stimulus, which could have more than offset the drop in household demand and boosted economic activities, thus positively affecting inflation. The second explanation is that our data selection is biased. Since our data set spans across only periods of crisis, it is possible that households have adjusted their expectation towards inflation and interest rate sometime prior to the hit of the crisis. This could result in succeeding periods where households have increased their saving rates, cutting demand, while the effect has yet to realize on CPI inflation. The second observation we had is that the coefficient of the first leg of saving rate was significantly larger in our GFC model compared to the COVID one. It was 0.164 compared to 0.014, and this result is at 10% significance. Agreeing with our hypothesis, this suggests that the saving rate had better prediction power during GFC, a demand-driven crisis. During COVID, it is possible that part of the household demand is unmet due to supply chain constraints from lockdowns, and therefore the change in saving rate does not influence output and price level as much as the way it did during GFC. The third observation is that the first leg of PMI carries a negative coefficient and was statistically significant in a VRR model during COVID. Note that we did not obtain a statistically significant coefficient for the same variable during GFC and therefore cannot make a direct comparison. That said, the result in the COVID-19 VRR model does not conflict with our hypothesis that PMI, a supply-side metric, played a significant role in CPI inflation during the supply-driven COVID crisis. So after going through our findings, it should also be said that there are several limitations in the study. First, the duration of the COVID-19 crisis was rather short, and due to the lack of data points, it is possible that our model failed to capture longer-term dynamics between variables during the two crises. Secondly, the adjusted R-square of our GFC model is unsatisfactory. One possible explanation is that there are qualitative indicators causing the changes to CPI, which are harder to quantify. Dropping other economic variables that potentially influence inflation rate might also cause admitted variable bias. Number three, the saving rate is only a proxy of household demand, so corporate and government demand are not taken into consideration. Moving on to conclusion, our study showed that empirical data does support the hypothesis that demand-side macroeconomic variable has a better influence on US inflation during GFC than in COVID period. And the supply-side variable has a significant influence on US inflation during COVID-19. This supports the view that the difference in nature of the two crises could be a major cause of difference in inflation response. And on the actual difference in inflation level post the two crises, we came up with the following reasoning after combining our findings with existing data and research. Unlike the GFC, the COVID-19 recession is supply-driven. Demand was likely pent up and unmet when supply side was disrupted. This possibly drove out price levels. And later, when supply side recovers under an expansionary monetary environment, inflation surged higher than it did post-GFC. Overall, our study on difference between inflation during COVID and GFC aims to provide a better understanding of inflation during economic crises. That is the end of our presentation. Thank you for listening, and we welcome any questions and comments.